Whether you're surfing the web, checking your portfolio, or watching the cable channel finance shows talking heads, you're bombarded these days with talk of inflation, rising interest rates, ongoing war, a bear market, and possible recession. So many reasons to worry. And when worry kicks in, so oftentimes does bad decision making. When your emotions run strong like this, it's time to take a step back, inform your mind, and get some perspective. So today, Adrian and Erik examine 5 topics that will help you do just that. First, we discuss the economy, including the question of whether we're on the verge of an imminent recession. Then, the policy responses to that economy, especially from the Fed. And then, the markets, including a discussion of growth versus value stocks, as well as bonds. Next, in light of that review, we explore what broad adjustments to your portfolio you might consider making to fit the environment you think we're in, including some specific ideas you could explore further, depending on whether you're expecting markets' next moves are mostly up, down, or sideways. Stay tuned as we discuss all this and more right now on the Retirement Lifestyle Show.
The Retirement Lifestyle Show is back with another exciting episode today. I'm joined with my co-host, Erik Olson. My name's Adrian Nicholson, and thank you all listeners and viewers for joining in today. We're really excited to talk about the topic today. And if you're joining us from YouTube, we hope that you'll enjoy this episode. If you're listening through Spotify, Apple Music, or wherever you're listening to your podcast, we're just as happy with you joining us today. And we're really looking forward to getting into this topic today. We're going to be discussing the current market environment and whether we're leaning more towards being bullish or bearish, and looking not only at the markets, but a macroeconomic level and just policies that are going on right now. It's going to be a lot of information, but I'm so excited to be joined here with Erik right now to discuss this topic. So let's charge right into it, Erik. How do you want to tackle this first?
Well, first, I want to say what a pleasure it is to do this show with you and just give Roshan a little bit of an elbow here and say, too bad he couldn't join us for this topic, which was actually his idea. And so we're executing Roshan's idea in this podcast. So Roshan, shout out to you. Hope you're having a good day, all things considered.
Yeah, that's great, Erik. Just give Roshan that shout out. And listeners and viewers, if you want to make him feel even better, smash that like button, subscribe, tell your friends and family about it, and just let everybody know if you really enjoyed this episode today. I'm sure we're going to have a lot of great content for you. So I'm ready to go right away. So let's take it away, Erik. How do you want to start this off?
Well, as I was thinking about this conversation today, are we bullish or are we bearish? I think it's important to understand we're approaching this from the context of financial planners and investment advisors to our clients. And so we, on a day in and day out basis, get a lot of direct feedback from a variety of perspectives and emotional reactions to what's surrounding us. And so I think it's useful sometimes, rather than just to charge directly to the bottom line, it's useful to do some background information, always to provide a context, both not just at the markets level, but also, as you indicated earlier, Adrian, at the macroeconomic level, at the policy level, and so forth, to understand what's happening around us that's leading to some of the things that we're seeing in the markets, and on the basis of both what has happened and what still might happen, then to have hopefully a more informed view of market action in the past and in the present and potentially in the future, so that at an emotional level, at least, we're all of us able to just weather and proceed without overreacting in a way that ultimately might lead to our harm.
Yeah, that's exactly right, Erik. A more comprehensive look, a more in-depth look, looking at the data is extremely important. Sometimes it's easy just to look at the statement or just look at the bottom line and just have a sort of knee-jerk reaction to it. But when it comes to planning, when it comes to decision-making, looking at as much as you can, all the data, the research, having a conversation about it can really help you stick to a plan and just be more informed when you're making a decision. Our job is to really lay out all the information, all the data to help arrive at a better decision, just to put the odds more in your favor. And who wouldn't want that?
Who wouldn't want that? So we're going to break our conversation down into 5 sections. So the first is a look at macroeconomic factors that are serving as the overall backdrop to all of this. The second is to look at the ways in which both the Federal Reserve, the administration, and as well the Congress, what levers, policy levers they have available to them and are using. And honestly, we'll throw in a little bit of an assessment, at least in my case, as to whether or not I think those levers are being wisely used. But at least we want to talk about the policy responses, both those that have been used and those perhaps that have not been. Third, we want to talk about markets, and we'll get into a variety of markets because when we say markets, they really are plural. And so we'll address both the stock market in the United States as well as the bond markets. Then third, fourth, I should say, is we want to talk about with all of the preceding as a backdrop, what sorts of decisions could you make with respect to allocating your portfolio? And of course, that will depend in part on your risk tolerance and your time horizon and your goals and so forth and so on. But it also, in this case, will depend on your overall expectations and interpretation and about where you think markets will go. But we'll at least talk about some allocation ideas. And then finally, in our fifth section, we just talk about specific opportunities. Specific opportunities if you're bullish, if you're bearish, or if you're uncertain. And so we can cover all the bases. So let's start with the macroeconomic. And at this point, Adrian, I'll take it away. What are some of your observations about what's taking place in the macroeconomic environment? Or if you'd like, I can show some slides that I think are useful in that conversation as well.
Well, the three areas I'm looking at that might line up to what you have are
Mm-hmm.
inflation. I think that's a big one that's been talked about a lot. And if you're a listener and viewer and you're just like, Adrian, I want to turn this off now. I'm tired of hearing about inflation. I can understand your feeling. And then the next one would be the war overseas and also the lockdowns as well that's disrupting the supply chain. So I think these three areas from a macroeconomic standpoint are very big factors that are really driving the markets and have people having conversations about this as well because they're all big areas. So inflation, the war overseas, and lockdowns that are affecting the supply chain. What do you think, Erik?
Oh, I'm right there with you. And in fact, I think the first and the third of those in particular are ones that I believe are being misread both by most investors as well as by policymakers. I think there's a sense that, at least at the level of the Federal Reserve, which we'll talk about policy responses a little bit more later, but that they think that they're in large part fighting inflation driven by just merely excess excess supply, or pardon me, excess demand for the supply that's available. I think there's more going on there, and I'll swing back to talk about that because I do think it's directly related to the disruptions and disequilibrium in a lot of the system of the economy that are directly attributable to the shutdowns and the slow and uneven recovery from those shutdowns.
Yeah, and it's really
So.
just touching on all areas of life for people. If you think about it, just inflation just affecting everybody's everyday balance sheet. Their expenses are going up. And
Mhm.
that's also in part to, again, just lockdowns and shutdowns and everything that's going on overseas isn't helping it as well. So wherever you're really going or whatever sector or industry you're a part of or you work with, you're kind of feeling both ends of it. So that's why we're just having that conversation again today, just to really break it down, look at it, and see how it affects your overall situation.
You're here. So what I want to do is, I'm sure, Adrian, you're hearing from clients a lot lately. Hey, are we in a recession yet, or are we on the verge of a recession? Have you been getting that question from clients?
We have been getting that question. Also, Google is just a good data point to just look at where recession is being searched now more than ever.
Hmm. All right. So here's the way that I want to address this is there are a variety of leading indicators that have been used to help people determine whether or not, or have a little bit of a crystal ball, if you will, as to whether or not there is a recession around the corner. And while there are certainly improvements on the version that I'm about to identify, actually, both of the versions I'm about to identify, the one that you probably hear most widely and confidently cited is something known as the yield curve. The yield curve, typically, at least among financial professionals, when that term is used, they're referring to the difference between the interest that is being offered on a 10-year treasury in comparison with a 2-year treasury bill. What's the issue? Normally, in a normal environment where people's expectations are not looking for some sort of decline in the economy, they might say, well, I'll lend the federal government through the purchase of this 2-year treasury bond. I'll lend them some money and I'll expect this interest rate in return. But if they want to hang on to it for an extra 8 years, wow, that's a long time. I'm going to need to be paid more each year to give up all of the other opportunities that I might be able to use that money toward, and hence the yield curve is positively sloped, meaning it is higher for the longer dated. The interest rates being paid are higher that for the longer dated maturities than they are for the shorter.
Yep. And then, Erik,
When
there's the dreaded inverted yield curve, which I know you're about to get into.
Right. So this is the thing that people look at and they say, well, when there is an inversion in that yield curve, first of all, let's define that. Let me finish the sentence and then I'll define it. When there's an inversion in that yield curve, that has presaged every recession going back for, decades and decades. What they should also add in is that at times the yield curve inversion presages no recession. So it's not as though every single inversion is followed by a recession. But nevertheless, here's what the inversion is: that the interest that is being paid on the 2-year is higher than the interest being paid on the 10-year. How could that be? Why would investors want more compensation for a 2-year loan to the federal government than for a 10-year loan to the federal government? Well, here's how it works. If everyone is, or at least a significant number of investors are growingly pessimistic about the markets, at least the stock markets, because of their link in some ways to the economy, they may say, wow, I don't think I'm going to be well rewarded if I put money to work in the stock markets. Instead, what I'm going to do is I'm going to just lock this money in for the next decade on some bonds and have some safety. Well, when enough people are chasing those 10-year bonds, driving up their competing to purchase them, it drives up their price. When it drives up their price, it drives down their yield. And so what effectively is happening there is that the demand among concerned investors for those 10-year safety tools, the 10-year treasuries, causes the yield on those to fall and do so beyond what is happening on the interest being paid on the 2 years. So that inversion is what many financial professionals will talk about when they cite the inversion of the yield curve. It's a highly accurate measure, but it's not as accurate as some other things. Let me pause there. Adrian, any observations about that?
It just shows you the power of supply and demand. And also the other point that you brought up as well, how long people are really willing to lock up their money for a certain period of time. Because again, opportunity cost is a very big factor here. Do you want to get paid a lot or a little bit depending on the time frame on how much you want your money to be locked out? So it's extremely important. And like you said, if there's a bear market, if there's signs of a recession going on, people want to flee to more safe assets. They want to not have so much volatility in their portfolio. But there's also a lot of other people that are doing it as well, which again affects the supply and demand aspect of it. So it's something that it's a very big indicator that people do look at to see if there's a recession on the horizon or not, and just seeing what people have an appetite for and what's in demand.
Well, that's exactly right. So, what I wanted to highlight was in contrast to that yield curve measure that most financial professionals use, is the yield curve measure that most academics use. And actually, studies show that in this case, the um, academics have got a better tool in their toolkit than the financial professionals do. And this yield curve inversion is measuring the 10-year treasury, just as was true a moment in the previous example, but it's not compared to the 2-year. Instead, it's compared to the 3-month. This 10-year versus 3-month treasury bill measure incorporates an additional element into the mix that is obscured by using the 2-year. And specifically, that is, what might the Fed do before those 2 years have passed? So in this case, the 10 versus 3 is a highly predictive measure. It's had a miss or two as well, but it seems to be overall a better tool. Let me show a couple of charts actually that will bring this a little closer into focus.
And
So,
Erik, out of habit, could you also bring in the importance or how duration plays a big factor into this? Because when I used to research and study a lot about inverted yield curves and just long periods of locking your money up or short terms, especially when it comes to bonds, duration is a very big aspect of this that I think some of our listeners and viewers aren't so familiar with, that might be interesting for them to make note of.
well, so the principle of duration is closely connected to, but not identical with, the concept of maturity or years until something matures. And so I'm going to use that concept because that's the easier one probably for people to understand. But in general, when there are interest rate moves, then the longer the duration, or again, as a proxy for this, not an identical term, but at least a proxy for this, is the years until something matures. The farther out in time that something matures, the more its price will respond inversely to an interest rate move. So if there is a, let's say, 0.25% move in the interest rates, or as was recently um, uh, put into force here by the Federal Reserve in May, or actually no, in June, and when they did a three quarter point percentage increase in the Fed funds rate, what happens is that something that is denominated with a 1-year maturity, it feels the price impact of that rise in interest rates gently, but something that's a 30-year treasury, that same three-quarters point interest rate change would affect its price much more adversely.
Yeah, and it just shows
So,
you the power of how policy can quickly impact certain asset classes just immediately. So that's definitely
mhm,
something that viewers and listeners should always make note of. So I see that you're sharing your screen here. Can you explain this
yeah.
chart?
Well, sure. And let me just, since you did raise the concept of the duration, let me just say that the inverse is also true. If there came a point in time at which the Fed said, hey, we're going to cut rates, then the ones that would have the most um, upside move on their price would be, again, those longer dated bonds. So that's why, when we had, what was it, 18% interest rates on 30-year treasuries back in 1981 or 2,
Hmm.
and those interest rates declined over time down to eventually the 0 point. Those bonds made so much money as they rose and rose and rose in value. It's just incredible. But here's what we're looking at is a graph of the yield curve. That is to say, the relationship between the 10-year treasury and the 2-year treasury over time. And what you see is this, first of all, is the blue mountain graph going up and down and up and down. That's that relationship between the two of them, the percent difference between the two. And then you see a horizontal line, black line running through the middle, that is the 0 point. So an inversion in the yield curve is whenever that graph, that dynamic graph, moves below the 0 point. That means that, again, that 10-year is paying less interest than the 2-year. Notice that shortly after those inversions, there is that gray shaded area on the graph
Yeah.
vertically. That gray shaded area is a recession. And so what you can see is that in almost each of those instances, when there was an inversion, then it was followed at some interval by these recessions. So that's why it's closely watched. Here's the version which is using the 3-month. This is also going back as far in time as we have this. So this is back into roughly 1980 or 82 or somewhere in that neighborhood. And what you see here again is that when that goes negative, meaning it goes below that zero boundary, then it's followed by a recession, as you can see most recently. Well, in 2020. I want you to look on the right-hand side of the graph.
It's moving up.
It's moving up. In other words, it doesn't look like, at this moment at least, it's headed for the zero mark. So when people say, "Are we on the verge of a recession?" I would say, it's possible. It's possible that we're on the verge of recession, but the historic sort of one of the most dependable indicators of that recession is not pointing that way at all. And now it's true that in the case of the 10 versus 2, which we're looking at right now, we got an intraday momentary blip on where it was breached. So you can see back here on April 1st, there was a tiny, breaching of that level by 0.05%. And right now on the far right side, using data from June 21st, 2022, it's barely positive. But again, stepping back and looking at it at a maximum level and looking at the more reliable of these two, the 10-year versus 3-month is not showing that. So, bottom line is that when people say, "Are we in a recession?" It's hard for me to say or that we're there yet, even though we did have that one first quarter print that was negative GDP year on year. But I would say right now, my answer to that would be no. We're not yet on the verge of recession. Having said that,
Yep.
I don't put it past the markets or the economy to have a decline in 2023 or 2024. Let's talk about that for a little bit. What in terms of your thinking about the recession question right now or looking out a year or two, what are your thoughts about that, Adrian?
So I'll just go into what some of the data I gathered today and the overall theme right now. Maybe some of the listeners or viewers are asking, so what are you? Are you bullish or are you bearish? And right now, for the short term, I do have a bearish outlook right now because I've been doing a lot of research prepping for this podcast. And again, we talked about some of the macroeconomic factors that are going on. Inflation's running hot. There's a war overseas, and there's talks about more lockdowns, which will affect the supply chain issues. So there's a lot of macroeconomic events that are going on that really have me questioning whether or not I should be bullish right now on a short-term perspective. So I'll just put that for a 6 or 1 year window where I say I have a little bit of a bearish outlook right now. And I also gathered data from this nonprofit organization, AAII, which is the American Association of Individual Investors. Are you familiar with them, Erik? Just curious?
Yes.
Yes. And this is an organization that's made up of over 150,000 members of the investing world community. And recently they released their sentiment survey, which measures a percentage of the individual investors of AAII. And they just asked them, are you bullish, bearish, or are you neutral on the stock market right now? And a majority of them, around 60%, have a bearish outlook, 20% bullish outlook, and 20% a more of a neutral outlook right now. So just having those numbers, they're weighing more towards right now investors are having a more of a bearish outlook. But they post this data on a bi-weekly. So the last report came out June 15th. So what what the markets have been doing recently, this number could have gone down where there's more bullish investors or more neutral compared to bearish. But right now, as of June 15th, 60% of them have a more bearish outlook. Do you want to comment on that? And then I have another piece I want to go over.
Well, I was hoping you were going to comment on that because I take what you just said as actually a bullish indicator. So I'm very interested to hear your thinking about that.
So would that make you more of a contrarian approach? That's a big aspect on whether
Yes.
you're bullish or bearish. So that's what I was thinking, Erik.
Yes, it's absolutely the case. So when many people are
Mm-hmm.
really down in the dumps about markets, my thought is okay.
Yes.
That's a you reach sort of peak pessimism, and it's hard for any more people to join into that pessimistic party.
Yes. And pessimism is above its historical average right now. And people haven't got this much of a bearish indicator since 2009, which is the data I was looking at. And again, I said I'm bearish on a short-term basis. I give this a 6 to 1
Hmm.
year time frame because on a 2-year time frame, I do have more
Hmm.
of a bullish outlook from this data I'm about to present to our listeners and viewers right now. This data
Hmm.
that I collected has the S&P 500 and the bear markets and recovery data. So I'll just go through this with our listeners and viewers right now. This has 3 data
Sure.
points. It has the length of bear markets in months. Then it has the S&P 500 decline in percentages, and then it has the length of recovery in months. So I'll just kind of cut this data in half right now, and I'll start from 1987, and the S&P 500 had a drop of around 30%, and the length of the bear market in months was 3 months, and then the length of recovery was 4 months. In 2000, the S&P 500 had a decline percentage of around 40%, and the length of the bear market in months was 31 months. The length of recovery in 2000 was 56 months. From 2007, the S&P 500 had a decline of around 50%, and the length of the bear market in months was around 17 months, and the length of recovery in months was 49 months. And then finally, 2020, the length of the bear market in months was only 1 month, and the decline was around 30%. The length of recovery in months was 5. So the whole reason why I said that I have a more bullish long-term aspect
Hmm.
for 2 years is because when you take all of my data and you average it out of the length of recovery in months, it comes out to 2 years. So this is why I have a more of a bullish outlook, because when I averaged out the length of recovery in months, it came out to 23.22%. So I just rounded up to 24 months, which is 2 years. So this is why I have a more bullish outlook in that time frame.
So let me summarize. You're saying, hey, in general, if there's roughly, some sort of measure of centrality here is roughly 2 years of recovery.
Mhm.
Then, if I look out 2 years, then I suspect that we'll be in pretty good shape.
Yep,
That's
exactly what I'm going to.
Adrian. Okay,
Yep.
all right,
And right now
interesting.
we're 6 months into it. So that's about
Hmm.
25, that's 25% right now. So
Hmm.
I still, with that 25% short term, I have a very bearish outlook right now. But as we get closer
Hmm.
to that 2 year mark, I'm going to be moving more into the bullish camp.
Okay, interesting. Well, so I want to. We had talked about having sort of five um, topics. One was macro, one was policy, one was markets. We've now entered into a conversation about macro markets, I should say. So I want to step one step back and go now talk a little bit more about policy, and then move forward again into markets. Is that
Yes,
okay
of
with you?
course. Take it away, Erik.
Okay. So what I want to do here is once again share my screen and talk a little bit about the policy responses that we're seeing, and what we're in particular what we have is in the case of the Fed. We're the primary measure that they're using currently is to raise rates. So I've captured a graph from the website currentmarketvaluation.com. I encourage you to look at it. The creator of this website is bright and writes well and gathers a number of interesting measures to track here. But what I wanted to show you was this is going back to 1955 on the far left side and up to the present, more or less, within the last week or so on the far right side. This is the federal funds target rate over time. And what you can see is that it ranged from the ones, twos, threes, and fours back in the 50s and climbed until in the 80s it was above 18, 19% in the early 80s. And then over time has been reduced. But since the great credit crisis of 2009, with the exception of raising rates in 16, 17, 18, and so forth, and then trimming them back, especially when COVID hit, going straight back to zero, we've been essentially for the last 12 years with that one interlude from 2016, 2017 to 2020, we've been in a period of essentially zero or near zero target rates for the federal funds rate. My contention is that while I understand that's being viewed as an inflation fighting tool, and I agree that it does combat inflation. I think another tool that's at the Fed's disposal, which it doesn't appear they are tracking or attempting to adjust, is money supply. Adrian, we've talked about in a previous episode the concept of money supply as a especially when it comes to the velocity of money, how many times it changes hands in a year. Let's say I buy something from you, then you take those dollars and you buy something from someone else, then they take it, they buy from someone else. How many times do those dollars change hands? Well, velocity is part of it, but so is money supply. And my view is that it would be somewhat better overall if the Federal Reserve was focusing on the supply of money and interest, because I think that's going to happen here in interest rates. While I believe long run interest rates need to be higher, right now I think it is possible that they could go too fast on that. They might have a faster policy response on the inflation side if they dial back money supply instead of if they are strictly focused on interest rates. So that's just one area, because I think this problem is driven, as you pointed out early in this episode, Adrian, to a large extent about the disequilibriums introduced into the system by what took place with COVID.
Mm-hmm.
And if you policy responses to COVID and shutdowns and related to all of that. So it's on the one hand, allow that system to be sort of unfettered, the economic system be unfettered by any sorts of constraints that would normally be sort of the lingering aftermath of COVID policies. And number two, reduce the money supply somewhat after having juiced the system with way too much capital. And then at that point, then see what needs to happen on a more gradual basis with interest rates. Any questions about that, or if not? If otherwise,
Well,
I'm happy to start talking
just
about
right
markets.
there with you, Erik. Just a
Hmm.
refresher, just for people that aren't familiar with it. Again, just a lot of money was just put into the system just to get our economy going when a lot of stuff was getting shut
Hmm.
down just related to COVID, right? So then you just fast forward a year or two, the Fed's response to this is just to raise interest rate, kind of tighten the economy up, tighten just the easy money that, let's just say, businesses are using right now, just to kind of constrain it a lot more. Where right now it's kind of just like in lockstep, where there's a lot of money still going into the system, and just rates are trying to constrain that a lot more. And you're really just seeing it affect different companies differently that are just highly leveraged, or where more people are looking for just more earnings, more profits, more just stronger balance sheets right now, because again, interest rates are just so much higher. So it's very company specific, which impacts the market as a whole.
Hmm. Right. So let's shift to topic three, which is about markets. You already had gotten us launched well into that subject matter. So rather than just repeating the ground you've already covered, let me just highlight a couple other categories of thinking about markets broadly speaking. Number one, if I were to ask you, Adrian, whether growth stocks or value stocks have been hit harder by the increase in interest rates, which would it be?
So, like what I just mentioned, growth stocks are getting hit the hardest this, if you take example, one of the areas that they get impacted the most is because some of these companies, let's say these growth stocks, where they're really focused on, or investors are focused on their future earning potential right now, and they
Mm-hmm.
need
Mm-hmm.
money to leverage them just to be able to stay in business right now.
Mm-hmm.
Back in 2020, it was easier because there was more money coming into the system, where now less money is coming to the system. Interest rates are increasing, which makes their leverage even worse for them. They're getting impacted more, where people are looking more at these value companies that still have been impacted and still have gotten beaten down by the market, but are holding up a little bit well because they have a stronger balance sheet. They also have a yield too, which is more enticing to investors. They're looking at companies that are also buying back stocks as well. So value is looking a little bit better compared to the growth stocks, which have been hit down more. What do you think about that,
Mm-hmm.
Erik?
Yeah, I agree with that. And so for our listeners who may be thinking, well, why is it that growth stocks are hurt more by that? Let's just think about it this way for a second. Adrian, if I asked you to lend me $1 and I told you I'd pay it back in 10 years, would you be content to receive back from me just $1 10 years from now?
I wouldn't be content, because this kind of goes back to what we talked about with short term versus long term, locking up your money. Again, when we looked at the inverted yield curve, there's
Mm-hmm.
opportunity cost that comes with everything. If you have your money locked up for a certain period of time, you want a better rate on it, because again, there's other areas you can invest that dollar in that might produce more. So that's the opportunity cost that you would lose.
Right. So there's one thing right there that you just mentioned, which is the ever present time value of money and opportunity cost. Now, let's add into this conversation another factor. Let's say that I asked you that question in an environment where inflation was zero and interest rates were zero. How much would you want from me to repay you in 10 years for that dollar you
I
lent me
would at
today?
least expect to have my dollar back if everything's zero.
Okay. Yeah, you might say, you know what, Erik, if the interest rates are zero and inflation is zero, that dollar is going to buy me just as much. That is going to buy me just as much in terms of a
Mm-hmm.
basketball NBA package as on my cable as it will buy today. So yeah, a
Yep.
dollar, a little bit
No
more.
harm done.
No harm done. But if I said to you, we live in an environment where there's 10% annual inflation and 10% interest rates, how much would you want back 10 years from now?
I definitely want double, because again, I'm getting hit by inflation and I'm getting hit by interest rates as well. So I'm getting hit on both ends. So I definitely would want a lot more than just being complacent as I was in the original example, where I'm not really losing at all or not getting hurt at all.
Hmm. Yeah, you might actually probably need $2 or $3 to
Mm-hmm.
2.5 to $3 to make you feel like it was a fair trade. The same thing works in reverse. If a growth company's main value or value proposition to an investor is the future cash flows, because it's going to get bigger and more profitable, more profits. If it's those future cash flows, and now those future cash flows are being discounted back to the present at a higher interest rate and a higher inflation rate, then those same dollars that it would gain in the future are now worth less today. Hence, the stock is worth less today. One more factor, though, on these growth stocks: if they've been thriving in part because they've been able to borrow money at next to nothing, and now their opportunity to borrow money at next to nothing is disappearing, and instead they're going to have to perhaps borrow money at higher rates, that may mean that at their own ability to grow as big may be harmed. And furthermore, if there's a recession, as you had indicated, possibly in the next year or two, then it may be that further damages those businesses and their future cash flows. So as a result, growth stocks really take it on the chin when there is a spike in inflation and interest rates. Whereas value stocks, by contrast, the primary rationale for purchasing a value stock today is the perception, at least, that the current business that they're doing and the profits they're generating, the free cash flow, the sales, the revenue, the dividends, etc., those are currently on sale because the price of that company is less than what that that company is currently worth, not necessarily what its future value alone is. So, and that's precisely what we've seen happen in this phase of this increasing interest rate environment, is that value stocks, while they, especially more in the last month, I'll say, have gotten hurt. If you look back to where much of this started in October of November of last year, it's much less downside for value stocks than has been the case for growth stocks. So there's one observation about markets. Here's another in terms of just looking at bonds. Have the bonds found a bottom yet? Have treasuries that are now in the neighborhood of 3.5% per year, is that where they will finish? Or will they go a little further? Will they go to 4% interest on those bonds? Or where will they go? I don't know. I don't have a crystal ball, but I would at least say it seems to me on balance that we're closer now to where they might eventually settle in and the interest rate that they'll pay than they were, some time ago, because we've seen a pretty precipitous decline in the value of bonds since August of 2020, but in particular during 2022. Any comments about the bond market?
Would you say it's just contingent right now with some of the two biggest factors that impact bonds, just interest rates and inflation? If inflation continues just to run hot and the Fed's only kind of avenue to really control this is just to raise interest rates, that could
Mm-hmm.
really impact how bonds do because of the inverse relationship bonds have with their interest rates and price. As interest rates go up, prices go down. As interest
Mm-hmm.
rates go down, prices go up. So a big contingency, I got to believe, is what interest rates and overall inflation does to this asset class.
Yeah. Yeah, I'm with you there. So it's of course it's not certain what might
Mm-hmm.
happen with
Yeah.
them, but I'm just in terms of thinking about markets, I don't want to ignore discussion of the bond market. So Adrian, I'm ready to talk about the fourth of our five topics, which is ideas about allocations. Do you have some thoughts about that, or do you want me to launch in?
You can launch it. I'm looking forward to this one.
Okay.
Allocations.
All
That's
right.
definitely big, especially with this new market environment we're kind of experiencing right now, where you just need
Mm-hmm.
to look at overall what you're invested in. Are you overly weighted in one area right now? Are you underweight in another area right now? How can you really, a common term I'm hearing is just upgrade your overall portfolio right now with the changes that are occurring in our macro and economic environment?
Mm-hmm. Well, so I'm going to have three broad comments about allocation. So, and one or two of them are going to sound either like a broken record in one case, or slightly contradictory in the second case. But I'm going to talk about them and try to reconcile them. So the first is I believe that still a diversified portfolio is the best approach, because there are still a lot of unknowns. No one can say at any given point in time what will with certainty thrive the most, and which one will suffer the most, uh, not with perfect certainty. So diversification, I think, is appropriate, and certainly um, not just across various asset classes, but within asset classes.
Mm-hmm.
Having said that, insofar as this is a relatively choppier time, it seems to me overall, it does, as this whole question of, are we going to be in a recession in 2023, 2024? Are we in one now? All of that sort of thing settles out as the question about where will the Fed finally call it quits on raising interest rates. All of those elements of uncertainty. I think until there is some sort of clarity, particularly on what the Fed intends to do, it's not likely that the market is just going to ignore what the Fed is doing and start racing higher. So in this case, one approach might be to just be not going for broke on an all stock portfolio, if that might be customarily your approach. You might want to dial it back somewhat on that, and it might be that you do some of that in bonds. It might be that you do some of that in cash. It might be that you do some of that in commodities. And or if you're using bonds, then possibly treasury inflation protected securities, which we had discussed in a previous episode. So there are a variety of things there. But one thing is stay broadly diversified. Then within stocks, just for the same reasons that we just discussed in the contrast between growth and value, my bias, at least, and I'll speak for myself, is my bias for now is a tilt toward value, but not just even within the value family. There is value. There are value stocks that deserve to be underpriced because they're really terrible companies, and then there are other stocks which are, it seems to me at least, undeservedly underpriced. So we have various measures of quality. If you want to give us a shout and have a conversation with us about quality measures, we can certainly talk with you about that. But a focus on the quality component of the overall value space, it seems to me, is a healthy bias to have right now, and particularly ones that are paying a decent dividend. The reason for the dividend is that, to a certain extent, you get paid while you wait for the price side of the equation to resolve itself. And if you're not using your portfolio for income right now, the distribution of those dividends into your account, if you're reinvesting those dividends, either through a direct immediate reinvestment plan or through a periodic gathering up of all the dividends that have come in the last quarter and then putting them back to work in the portfolio, both of those are fine. But that way, what you're doing is actually you're acquiring some positive momentum, even while the prices are moving in a somewhat choppy way. And if they do move in a choppy way, like I just described, then during the points in that choppy cycle that they're down, you're taking those dividends and dollar cost averaging into assets that are more attractively priced at that moment.
Mm-hmm.
So in that sense, you're buying even more shares of these companies when things are down. You might actually, as I say to younger people, you should hope for an extended downturn or an extended choppy period. You'll acquire a lot more shares of some good companies during that phase. But without belaboring the point, my emphasis here is on value, quality, and dividends as a bias within that portfolio overall. Thoughts or questions about any of that,
I
Adrian?
think it's all a great point. Just starting off with your diversification piece. There's just some people out there that say, "Oh, I'm diversified right now. I own company X and I own company Y. I own company A and I own company B." But if they're in the same industry or the same sector, you're not really that diversified, and also you're just under the umbrella of equities right now as well, which have just been getting hit this year. And you have to look towards other asset classes like bonds. But then there's the question of, are my bonds losing to inflation? So diversify even further within those bonds. And there's just a lot of asset classes out there, and the investment universe is huge. It's massive. You can pretty much make money off of any type of market environment, but like we said, you have to really dig in, do your research, have a conversation with somebody, and really look. One, are you diversified, and is this company or this investment a good for your overall situation? It's extremely important. And then
Mm-hmm.
going to the piece that you talked about, just value and growth too, just see if you're overweight in one area or not, and just dig a little bit deeper into what you're invested in. If you are in the value space as well, is this company have a strong yield, balance sheet? What are their earnings looking like? Do they have a positive forecast right now? What's kind of their outlook? Are they looking to step into any new areas? It's just a lot of looking at the overall picture and digging with inside it. I think is really important when it comes to just investing in your allocation. And again, just seeing rebalancing and just seeing if you're just over allocated in one space or not. Just get back to that level that you're at, because over time your needs, your goals, your risk tolerance, and your capacity changes over time. So making sure your overall balance is extremely important.
Mm-hmm. Well said. And particularly insofar as you kept in focus, the planning part of this is, it's not just about investment, it is about planning. So I want to talk in our fifth and final topic here in today's podcast. I wanted to say a little bit about some opportunities depending on your outlook for the markets. If you think that, if you're one of these that thinks, no, this is a great moment to go after some screaming buys, I have an idea or two there. If your outlook is that no, the market is really destined to have further punishing declines, I have an idea for you there. And if yours is, I'm not sure, or I think it's going to be sideways and choppy, I've already had one idea for you there, which is to focus on that portion of your portfolio that it is allocated to equities, at least be focused on quality, value, and dividend paying companies, especially if they're they're dividend paying companies that are growing their dividend. So let me talk about the pessimistic scenario and then the optimistic scenario. If you're a pessimist, this is not a perfect tool. It's an example of a tool. This is the tool I'm about to describe is by no means the answer for everyone. It's just to give you an idea of some of the approaches that do exist out there. And that is to use something known as a structured note. And I'm going to give you an example of a structured note that, given the current market and the current pricing of options, is something that's doable now. So by the time you hear this podcast, the opportunity will have passed, but you'll at least understand that these sorts of things in these sorts of market environments are available. So here's an idea of a structured note. The structure of this note is that, let's say I'm going to use $100,000 as an example just to make this conversation super simple. So you put $100,000 to work, and if at the end of June of next year the S&P 500 is down, no, pardon me, is up or flat. Let me start with that: up or flat. You get your $100,000 back and $9,000 more, a 9% increase. Doesn't matter how much the S&P 500 is up. If it's up 50% or if it's up 0.5%, you get paid 9%. If, on the other hand, the S&P 500 a year from now is flat, or pardon me, or down, not flat or up, but down, then nothing happens at that 1 year interval. Instead, you now have your ride on this structured note extends for another 4 years, for a total of 5 years. Now a second measurement happens. If the market is down still at that 5-year mark on a price basis, the S&P 500's price is lower, you just get all your $100,000 back. But if the S&P 500's price is higher than it was at the end of June of this year, then you get all of that upside. Said differently, at the 5-year level on a price basis, not dividends, price basis only, if it's down, you get all your money back. If it's up, you get all of that increase. Kind of an interesting approach. If you're really, really thinking that the worst is about to happen, you might want to make an allocation to one of these types of tools. And there's other ways in which these sorts of tools can be packaged. It's just giving you an idea of how you can use structured finance to build a sort of defined set of outcomes. Now, what if you're on the flip side? What if you're very optimistic? Then I would say, and this is again not a prescription for everyone. This isn't going to fit everyone, but it is an observation about one subsector. I've been talking about this, at least referencing this from time to time, and that is biotechnology. Unlike a lot of other sectors of the economy, biotechnology is not driven by what's happening in the macroeconomy. It's driven by the science and the pace at which those breakthroughs can be made. But what's happened in this period of growth stocks getting completely trashed by people saying, wait a second, with these interest rates going up, this is just not a great place to be. Biotech's been thrown in with all of that. Now, there are other reasons that biotech's been punished as well. I'm not going to get into all the details, but at this point, you have probably of the observable universe of larger biotech companies, you have something like 120 of them are trading for less than their cash on hand. And the group as a whole is trading for roughly 2 times their cash on hand, when the normal pricing for that sector as a whole is 4 times cash. What that tells me is that there's been a kind of an irrational, just as there can be an irrational overreaction to the opportunities that they represent, and people can overprice them, and I fully acknowledge that happens. It also can go the other direction, and that strikes me as an example of one such sector, which is for the for those that are thinking very opportunistically about a possibility for you. It's not the only possibility, but I'm using that as an example to sort of highlight that there are ways, I would say, to find pockets of potential opportunity in this market.
Yeah, that's a good way that you described it. I mean, when the markets are down like this, people are just looking for deals, buying opportunities, what has more upsides. And when you're looking at certain companies or certain sectors, you just one of the starting points is this sector or company that just get beaten down just because everything's going down, and you look at its overall business, you look at its financials, you look at its outlook, and it's very positive, and you come to the conclusion that maybe it did just get set off, not because of what it does, but just what everything is doing. And that might be where you start seeing the opportunity lying in there.
Mm-hmm. Mm-hmm. Yeah. Well, Adrian, really interesting conversation with you today. Thank you for engaging in this. And again, I'm sorry that Roshan wasn't able to be a part of it.
Yeah, I'm sure Roshan would have been really excited to be here, but I'm sure he'll be back next week. And again, it was a great conversation. We touched on a lot of areas. So I know our viewers and our listeners were like, that's information overload. But if you want us to just clear everything up, we'd be happy just to have a conversation. Or if there was an area that you want to know more about, I'm sure we'd be happy to also just dive more into that and look at it for you as well.
I would agree with that. Yes, listeners, if you found value in today's episode, I would encourage you to share it because, in particular, I think if you've been feeling a certain degree of heightened emotion through all that's been transpiring or going on around us, both in the markets and the economy and in the news, you'll probably find that many of your friends and loved ones are also feeling disrupted. We're hoping that today's episode is a rational response to all of that and a fairly broad summary of a number of the inputs that should be part of your thinking as you gauge what's going on around us. If that sort of has helped you in some way feel a little bit more at ease, we hope you'll share the podcast and let people know about what we're trying to accomplish here to help you. All right. Well, listen, Adrian, without further ado, let's just thank our listeners and we'll talk with you next week, listeners. We'll look forward to that very much. And Adrian, I look forward to talking with you as well.